Welcome to Changing World, New Opportunities. This podcast is brought to you by the DC Investment Forum and hosted by me, Louise Farrand, and my co-host, Dave Whitehair.
This season, we're talking to the UK's leading master trusts. Millions of members and people in the UK now rely on master trusts for the future of their retirement finances. And we were interested to know how master trusts are investing and what the future holds.
In an uncertain world, how are they managing risk? And what's next on their agendas?
The DCIF's mission as a whole is to shine a spotlight on topical DC investment issues. And you can learn more about our research, follow us on LinkedIn, and subscribe to the show at dcif.co.uk.
Hello and welcome to Season 4 of Changing World, New Opportunities. I'm Louise Farrand and this is my co-host Dave Whitehair. And with us today is James Monk. Hi, James.
Hi, Louise.
So happy to have you here. You are an investment director at Fidelity, I believe.
Yes, that's right. I look after our strategy, FutureWise, but expand on that later.
Yeah, I can't wait. So you joined Fidelity in February 2023?
That is right,
I believe.
Yeah.
So we haven't spoken to Fidelity before on the podcast, so I'm really excited to chat and hear a bit more.
Plenty to cover. So I mean, having started at Fidelity, it's come at a pretty good time because there's just so much change, and the drive towards scale and consolidation couldn't be at a better time. Really, there's really much greater value on the horizon. By private assets and a whole host of other things. So looking forward to covering it.
Me too.
Excellent.
Me too.
I started my career at Fidelity. I spent the first 10 years of my career at Fidelity, and actually FutureWise was conceived when I was there. So I'm interested to know how it's been evolving since I've left.
All the best people have been out there,
So James, why don't you start off by telling us a little bit about your career path? Because I don't think you two crossed over at Fidelity.
No, we didn't know.
In the night.
So I mean, I kind of came out of uni during the financial crisis. So
did we. Not ideal.
Yeah, it's really tough, isn't it? But I mean, I actually originally went out into general insurance. And, that was actually out in Folkestone. But when I moved to London, I kind of started my journey in DC pensions with a company called PSolve that became River Mercantile Schroeder. And that was kind of really where I found my legs, to be honest. And, I kept on coming across this, why is DC not able to do the same things as DB and all that type of stuff? And, I was quite lucky to be given a lot of responsibility there. So I was kind of able to kind of really break down some of those barriers quite early on, discover all of the quirks of the life company and things like that. Mm-hmm. And then that was about 5 years and 8 years at Aon.
Yeah.
Looked after the master trust alongside others and did a lot of the provider selection process as well. So that really gave me a good viewpoint to look at all of the different platform defaults out there. And then picked Fidelity FutureWise strategy and thought it was in a really good spot. And, we've been really lucky to go from 6.5 billion kind of 2.5 years ago, and we're now 22 last month. So it's really flying. So
can you give us a helicopter overview of your investment strategy, FutureWise?
Yeah, sure. It's a target data fund structure, which basically gives us full flexibility to navigate markets. It delivers a more simplified investment experience for the member because they've got a single fund that they can carry through retirement. And it really is a very good structure for aligning with the objective of the member. So you want to retire by X date. So anything that you can then do to help you achieve that goal, like private assets and otherwise, should be considered within that objective, and it just really nicely delivers on the member need, really. We've just started introducing our private asset strategy from the beginning of this year.
Exciting.
Really exciting, and I think we're in a really differentiated space there. To be honest, we've really been pushing the boundaries. And we've already made our first 9 commitments to various different GPs. Mm-hmm. And I'm really pleased with the people we're selecting and, the focus on value as opposed to cost, to be honest. And I think it'll play out well for us over the long term, I hope.
And outside of the private assets, what other asset classes supplement the private markets exposure in FutureWise? Yeah,
sure. Sorry, I should cover that. So early on, we take a pretty sizable level of risk. We think it's all about risk for return, which plays out over the longer term, as you'd expect. As you get closer to Retirement, we've got a global diversified bond strategy, and we start to embed things like currency hedging, which make a bit more sense for the bond environment. I suppose you could probably argue that we've probably carried a little bit more risk than our competitors in that space historically, but that's been something that we've been changing as the market environment's been changing as well. So we've recently completed a strategic review and shifted 15% from high yield to government bonds, again on a global basis. And we've actually started introducing a lot more tactical flexibility and tools. So over the last couple of months, we've been introducing minimum volatility equities at retirement, gold, and shorter duration bonds. So we're really trying to think carefully about what flexibility we need as market conditions change, and the outlook becomes increasingly uncertain, to be honest. So yeah.
And your equity allocation at the very start, how do you approach that? We've seen various approaches, and I know we'll be talking to people who have different takes on the equity market. Yeah.
So across the entire strategy, we've embedded, I suppose you could call it smart beta.
Okay.
So, and with the equity strategy, it's a globalized approach. Broadly speaking, it's very similar. In the early stages, it's very similar to a kind of a market cap regional weighting. But we do have that smart beta approach to make sure that we're kind of not overextending ourselves into things like concentration risks.
Right.
And albeit that does come with a fairly sizable US allocation, that's one of those things that we're constantly keeping sight of. And actually, things that we need to really be careful of are things like the Trump influence on the Fed and what that means for US dollar and things like that. And I think we've seen that play out over the last few months quite a bit. Lots under consideration at the moment, but it's a global approach.
Okay.
Which brings us really neatly, I think, to next question, which is all about risk management, obviously with so much going on at the moment. How have you changed? I know, how have you changed what you do in response to all this uncertainty? Although it feels like it was ever thus at this point in our kind of careers, doesn't it? It's never really been a certain time that I can remember.
Yeah, it's never calm.
Yeah. I mean, it's always the kind of the slight fallacy of you design a portfolio based on, at least partly based on market conditions, and it's always the next thing that surprises you, whether it's the AI bubble or whatever that might look like. So to be clear, I don't think actually we have the view that there is an AI bubble as yet. There are definitely pockets of overvaluation, but it's pretty hard to kind of tarnish the entire sector with that brush, to be honest.
Yeah.
And there is an ever increasing need to generate more productivity. So there's a lot. AI has a really important part to that.
Yeah.
In terms of risks, we're quite focused, as you'd expect, on things like inflation risk, and how that's going to play out on a regional basis. What the kind of the global rewiring of trade looks like as things like tariff policy starts to be implemented and get ever more pointy, as it were. As he kind of as Trump different themes start to come into focus, that will naturally drive a lot of volatility. But that being said, the fundamentals as yet are yet to kind of turn significantly negative, to be honest with you. I mean, I think that personally, I hold the view that labour markets are one to watch very closely over the next sort of 3-6 months, just because we could start to see some of that percolate in the UK, for example. And I think there's a lot of reasons that we need to be just mindful of the balance between where labour markets sit today and how the central banks are approaching that relative to inflation risks and what that means for bond portfolios. So
yeah.
You've touched on multiple asset classes and your kind of governance framework so far. The theme of diversification, how do you see that in today's market?
Well, you can look at that through a lot of lenses, really. I mean, certainly private assets in the growth phase, but as things like the pension schemes bill comes into frame and we can think about retirement defaults, that enables us to think about a much longer investment horizon for individuals. So absolutely, private assets have a big part to play there.
Yeah.
And we've touched briefly on the US and the concentration risks that are increasingly becoming obvious across the market. But one of the things that I think I haven't seen a strong answer to yet across the industry is as more and more companies stay in the private universe and more opportunities stay in that private universe, how do we bring greater transparency and data to evaluate the size of that opportunity versus what we're looking at over here in the listed market? And I think that, the data, private markets operate on a slightly stale basis on that, that, but there's a lot of reason for us to try and get better data and think a bit more, forward-looking in that regard. So things like megatrends are really, really good ways to kind of capture that value in that respect. But there's ever more increasing reasons to think about risk management at retirement and how you diversify some of that risk, particularly around things like inflation when you start to lose that protection.
I guess one risk for master trusts, or one thing to think about certainly, is consolidation. How do you think that's going to affect you from an investment perspective? I guess operationally it might have some impacts.
Yeah. To be honest with you, FutureWise is in a fairly fortunate position. We're at 22 today, and should be 25 by maybe end of this year, early part of next year. So we're not seeing that scale threshold as being an issue.
Yeah.
We also, unlike a lot of our competitors, we have a single default strategy, which means that we do the best by all of our members. And we've already gone through a lot of that consolidation pain that a lot of others might go through as they kind of meet their Mansion House Accord type commitments. And, when I think about the direction and, some of the things that might happen for others, I'm particularly focused on this 2028 to 2030 bracket when contractual override powers come in. There's a lot of consolidation and sweep up of legacy strategies. And you potentially, as a provider, haven't, by the nature of that kind of diffusion of the allocation, you're going to be under allocating to private assets, and your commitment's going to come under threat as those mandation powers are going to start to kind of percolate through the system. So I think it could force a lot of people to allocate on an accelerated basis to private markets at a time when we really ought to be thinking about staggering the maturity of private assets, really building that up slowly. And I think that will hold true to build a more resilient portfolio in lots of ways.
How have you found that journey of, I guess you've always had a single default, if I'm right in saying, but there are others in the market that provide multiple options for savers. How have you found that and interacting with the trustees that oversee the master trust and the conviction behind that?
Yeah. So we actually did a bit of a research paper on this back in, I think it was 23. And, we've probably had some flack on the annuity and cash glide path. But when you really evaluate it, I mean, a great example was the trustonomics scenario in 23, when you had this kind of, 22. And you had this kind of huge loss in value from pre-retirement bond funds. And, albeit their purchasing power had actually improved, Fidelity pre-retirement bond kind of, enhanced that purchasing power, but you still, it still lost about a quarter of its value. So, and you get people phoning up and you saying, well, hold on, where did all this money go type thing? But, it's not through market conditions, and actually it delivered on its objective and being able to improve that purchasing power. So there's basically a bit of a disconnect in terms of what people actually want and what, and they're kind of more focused on absolute loss than they are relative loss to their decision. And that happens because they're not sure when they're going to retire. Perhaps they want to defer it, not sure how they want to retire. And being honest, given that volatility in prices, how could you realistically say that you were going to buy an annuity 5 years prior to that, for example? You don't know what value annuity is going to offer you at the end of that 5 years. So I think there was a bit of a lesson learned across the industry in terms of, people make the retirement decision that offers them the best value at a point in time. And so therefore, if you don't really know what you want to buy, etc., then you just should focus on the simplicity of maximizing pots and outcomes. And actually, affordability drives that flexibility. So that was kind of, I think it's fair to say that, in some ways, the market's been a little bit slow to that kind of ethos historically. I think with the consolidation dynamic making us look a little bit more like Aussie supers, less and less reason or value offered from annuity and cash glide paths. I do think it's kind of coming toward this single default type strategy, particularly as people have made those Mansion House commitments and there's greater governmental pressure to kind of, allocate to private assets and, think more carefully about that.
Yeah.
So we've talked quite a bit about private markets, and now, look, we've got a whole section of questions about private markets. Hooray! Let's start at the beginning. Tell us a little bit about your private markets strategy. So what are you invested in today? What are you thinking about doing at the moment?
Yeah, sure. Okay, so our private asset strategy today is an LTAF, as you probably expect, but we have a equal allocation to private equity, real estate, infrastructure, and private credit, kind of the four main asset classes. And we have a liquid portfolio on top to try and help us manage the liquidity scenarios and protect that private asset portfolio from any redemption scenarios. And when we're really thinking about the redemption scenario, I'm particularly focusing on when there's a public market shock, and then you need to bring your portfolio back into realignment. The ethos of the strategy, which I do think is very differentiated, is kind of differentiated on a couple of factors. The first is that we intend to allocate to the areas where there's the widest universe. And the heritage of private assets and the track record is strongest in closed-ended funds. And that also comes with performance fee challenges, where you need to think about treating customers fairly, because you've obviously got your member going in and out at a top level on a daily basis, and you do need to manage that. And the second point I would say we're quite differentiated is that we're looking to allocate to circa 20 different general partners and really build up access to quality managers in their sectors that build a long-term platform of origination across a really wide set of areas, to be honest. So that diversified implementation of specialist partners, that's a really, really powerful dynamic, we feel. And the final point, I think, which differentiates us is that, 95% of our private asset allocation will be external. We acknowledge that we've got some real estate and private credit capability internally, but the vast majority will be external. So we think that's a really big value dynamic for everybody to be considering, really. But yeah.
So obviously, it sounds like you're doing a lot of work in this space. Have you built out internal resource to help you go into this new area?
Of course, yeah. So we've got a great PM which comes with a background from Cambridge Associates called Vivian Liu. She's our lead PM. We've got Noah Shoram is our lead multi-asset private asset researcher. She's got circa 21 or so years of experience in private asset investing. And she's supported by 4 different private asset analysts.
Right.
And we've got and that's the LTAF team in isolation. All of them have got kind of north of 7 or 8 years of private asset investing experience. And there's a lot more peripheral support across the wider business, both in valuation, testing and compliance. There's infrastructure around and governance around decision making, due diligence to really embed that kind of those balance and checks to ensure that you're always embedding that quality in the portfolio.
Yeah.
There's a lot of other other people involved, but there's the kind of the core people. Okay. Yeah.
Is making direct investments at some point on your radar?
Absolutely.
Yeah.
I mean, those partners that we're building up, they're all kind of coming with co-investment flow.
Yeah.
So it's all about trying to build a unique proposition and portfolio, and it'd be crazy not to think about what that looks like into the future.
Yeah.
I mean, slightly behind your question is whether we intend to hold direct investments outside of the LTAF wrapper.
Yeah.
Look a little bit more like the supers.
Yeah.
And being candid, today we haven't really set our eyes in that in any particular shape or form.
Yeah.
But FutureWise today is an ACS regulated fund structure, so we're not kind of beholden to the life platform constraints.
Yeah.
So we could do that. We've got the capability to do that. But we do see a lot of regulatory protection in the LTAF structure, both in terms of the compliance angles, but also the kind of the liquidity management as well. So TBC, but we're kind of set up for it today.
Perfect. Now we can't talk about private markets without talking about Mansion House.
Yeah.
I think you've been pretty vocal about your views in this regard, but can you talk to our listeners and about whether you've signed the Mansion House Accord, and if you have or you haven't, what your reasons behind that are?
Yeah, as I understand it, I think we're actually the only workplace provider not to have signed either the compact, looking to allocate to unlisted equities, or the accord, in general, 10% to private markets, of which 5 is in the UK. All while we obviously, the multi-asset private asset team behind the LTAF actually were formed in 2022. So we were intending to do this for quite some time. So we've always had this ethos. We didn't sign the compact because it was kind of too focused on equities, and the accord because we effectively wanted to leave portfolio managers to allocate wherever they saw the best opportunity. And, typically speaking, I think you'd find on any portfolio, the more you constrain the implementation, the less free they feel to make the decisions that is in the best interest of fiduciary duty and members and outcomes. So we've just kind of, it's a voluntary compact / accord. So, we're just very keen to leave our portfolio managers free. And we very much believe in the fact that, private asset universe is a big one. I think, the FCA came out with a stat the other day whereby the UK is actually only 9.7% of private market universe. So how could you realistically expect to find half of your best ideas in the UK relative to that 10% sort of threshold? So we're just keen to make sure that we allocate in the best way possible. But, that being said, our portfolio is already allocated to one UK mandate, and that's focused on the senior care and living sector. So it's very much part of the portfolio. It's just we're just kind of approaching it in an unconstrained format.
So you are the only master trust to not signed either. How has that gone down for you commercially and with your trustees, with the advisory community?
Yeah. I mean, I think it's actually gone down fantastically well because I think increasingly the DC universe has kind of felt like it's kind of much over muchness in some ways. Like it's a very commoditized, there's been to a degree a bit of lack of conviction. We've got a single default strategy as well, where lots of others are kind of offering multiple layers. So what they're seeing from us is they're seeing a conviction in best idea strategy. And I think that conviction is holding true and has certainly been the case that, from an advisory standpoint, from an intermediary standpoint, they've always held the view that a globalized strategy is the way to access better diversification, a wider opportunity set. It all makes perfect sense. I mean, the accord does have some get out clauses. I suppose all we're doing by not signing is that we're just saying we're just staying away from the noise and we're just focusing on what we do best, really. So
makes sense.
Yeah.
James, one thing that we are talking to everyone about that I think is super interesting is private markets at the moment are being mostly used in the growth phase, it seems like. What are your plans for the future in terms of taking that into decumulation potentially?
Yeah, absolutely. So that's definitely on the roadmap. So the critical point there is around the pension schemes bill and that retirement default or standard retirement solution that I think will be offered across master trusts and default strategies.
Yeah.
So that will absolutely be embedded into the FutureWise target data fund structure. And we've looked at different ways to do this. Obviously, we need to be thoughtful around things like inflation risk. There's lots of different types of assets that we need to be thoughtful about. We want to make sure that there's plenty of cash generation in the portfolio, a bit more of an income orientated approach. And yes, you'll see something from us in the future in that space. But we really needed that retirement default to then be able to say, right, we can actually assume that a member is going to be with us well in perpetuity, whereas perhaps if they were 60, they might have been with us for 5 years, and then perhaps the 60-year-old is not going to get the full cycle and benefit of that private asset. So we wanted to make sure that members were always benefiting from the full cycle of that investment ethos, and so we were kind of waiting for that retirement default, really. But yeah.
And from kind of an investment point of view, does anything need to change for it to be kind of easier for you as investors to manage private markets into the later stages of someone's life? I guess it depends on what the private asset is.
Yeah.
As to whether it'll work.
I think the industry is ready for it. It's just been waiting for having the rationale or the backing behind the objective of a member going to and through right into until death, effectively. So I think that is coming, and we intend to make sure that we're maximising the opportunity, really. But yeah.
So one of the major themes in our industry for a number of years now has been sustainability.
Yeah.
Where are you in regards to the goals you initially set, and how do you measure your progress against those?
Yeah, so FutureWise is committed to net zero. We have a target of halving our emissions by 2030. We monitor our carbon emissions in a few different ways. Primarily, that target applies to Scope 1 and 2 because we can't necessarily rely on the accuracy or the assumptions behind Scope 3 as yet.
Yeah.
And our carbon reduction as it stands today, certainly across our public asset portfolio, is we've actually made a reduction of circa 65-70%. So really good progress. So we've exceeded that halving emissions target by 2030. Obviously, it's a bit trickier when it comes to private assets in many ways. Of our first 6 commitments that we made, 2 were Article 9, and the remaining 4 we kind of classified as an advanced ESG rating. So we're absolutely embedding that ethos, but the challenge is about a quarter of private assets today are TCFD reportable. So if you kind of bring it back to that ethos of maximizing your opportunity set, we just didn't feel that was worth reducing our investment universe by 3/4. So absolutely allocating in a sustainable net zero way, but we just, the industry isn't quite ready for that yet. So we're making a lot of progress in that space, and obviously engaging with managers to try and gain greater transparency. But we have our net zero commitment, and we actually also have a quarterly target of having a carbon emissions that's below the composite benchmark of the asset classes as well.
Right.
So we wanted to make sure that we were, because, for example, property, commodities, they are quite expensive, quite carbon intense asset classes. So you just need to be thinking about it relative to the diversification principles that has to kind of trump the net zero ethos, because as we know, it's all about engaging to improve rather than to try and ignore, I suppose.
What's next for you in terms of sustainability? Like, we've just done a report on nature, haven't we? Is nature on your radar?
Yeah. We've got a great chief sustainability officer, Jin Hui Tan. He launched our nature roadmap, I believe, testing me, September last year. Okay. Biodiversity is a really good early warning sign to a lot of these issues. We've been embedding it through a deforestation framework and making sure that we start to think carefully about how we integrate that into our stewardship. And one of the ways that we've been thinking about things is that we obviously capture a huge amount of data, and one of the people that we take data from is ISS ESG, and they're very good at kind of reviewing the physical risks on a location basis. So we kind of embed that into the ethos as well. I think one of the things that I didn't quite appreciate on the outside, but I've kind of felt on the inside, is that a good example is some stewardship we did with a particular fast food chain in China. So we actually, they were kind of keen to mitigate their palm oil footprint, as it were, but didn't really have a way of evaluating that on a plantation by plantation basis. So rather than it being, so what progress have you made on your palm oil reduction target? It's, actually, we can put you in touch with this kind of AI satellite imagery company that can help you monitor this, and then start to embed it in your governance framework. And I think that kind of, it can be quite helpful to try to be proactive in that engagement. And you can do a bit more of that when you've got sector-focused analysts that are kind of doing this stuff, because they see they can kind of percolate some of that idea generation and mitigation around sustainability principles kind of across the sector, which is quite helpful. But I think that's quite a good part to the way that we approach for the stewardship and Fidelity, where you're looking to provide solutions to these problems through that stewardship, and you're kind of integrating that kind of forward-looking stewardship view into the kind of portfolio construction, which can be really helpful. Kind of because my bugbear with a lot of ESG at the moment, as it stands, is a lot of it focuses on this carbon intensity.
Yeah.
And it's a backward-looking public stat. So how are you ever really going to earn any value off that? And it kind of penalizes people for going through change as well.
Mm-hmm.
So we just really need to be embedding any principle that we can to kind of think forward in how we evaluate our companies in that respect. So there's been some really good progress in that space.
Okay.
I mean, kind of wrapping up the last two sections, private markets and sustainability, you mentioned you've allocated to a couple of Article 9 GP-led funds. Can you share any more about what you either have done already or what you're doing in the kind of sustainability private asset world?
So in the UK, we've focused on that social side, the kind of senior care and living sector, where we see a significant kind of demographic trend and kind of underservicing. Yeah. I think we've seen the NHS creak at the seams a little bit in that respect, it's definitely something to support. In Europe, within our own Fidelity climate logistics strategy, we've embedded a kind of a strategy to try and reduce carbon emissions across the European footprint around transport and just general industrial logistics. So that's kind of embedded in the strategy as well. There's quite a few, to be honest. We would do very much want to be looking forward at any innovative climate solutions. So that's taking ownership in companies as well. Mm-hmm. But we are allocating with an outcome objective. So it's not kind of necessarily a pure climate solutions private equity strategy per se. Yep. We're just picking up some of those. We're looking for that ESG integration in that allocation in the way that they select assets, really. So
Perfect.
You mentioned pensions bill earlier. From a regulatory point of view and specific to the pensions bill, how is that, or is it influencing the investment decisions and your thinking?
Being fair, it's a really tricky scenario of accountability in many ways, because as I understand it, the FCA is not too keen on being the party responsible for establishing what is in the interest of members. Mm-hmm. And we've also got, while it's a really positive step forward from Eversheds as a legal advisor in saying that you ought to be thinking about things like quality of living in kind of secondary benefits to solutions, which I understand it's quite an emotional thing, which is really positive. But the challenge comes is, in order to get yourself comfortable with the improvement in the quality of life.
Yeah.
There's really two things for me. The first is if you're investing in a hospital in Bristol, how can you argue that that's going to benefit the Master Trust membership, which is spread across the entirety of the UK, in that quality of life argument? So you're kind of benefiting one area rather than the populace.
Yeah.
Now that's less true for things like energy and kind of sustainability and renewables and things like that. But you get my point around the real asset piece.
Yeah.
And the second bit is, some of these opportunities, for example, co-investments, are kind of, you have to be there and ready to pull the trigger. Then the opportunity is not there for kind of months on end. You kind of need to say, yes, I want to be part of this.
Yeah.
And you don't have a kind of an indefinite period of time to make that decision. So, and the challenge comes about the due diligence that you then need to do to kind of evidence that improvement to the quality of life as an added due diligence requirement in what's already a constrained time frame. So it's tricky, is my point. I mean, I think it's worthwhile considering if you had two assets that were of equal quality and equal kind of value, one's in the UK, one's in global, sure. But it's still the investment ethos that's winning there, and it's kind of, and it does become very challenging to kind of embed that philosophy of thinking about the quality of life improvement. I mean, personally speaking, I feel that one of the main challenges to this is that if the government is looking to try and drive this agenda and is saying that they want reserve powers, fine, unprecedented in the UK at least, and the only other examples of that are kind of across the emerging markets. Fine, that's unprecedented, but they are not yet implementing those mandatory powers. They're just saying that they've got that power in reserve. So they're still expecting the master trusts to behave and to allocate in the way that they see is going to drive the best member outcome for members. And the most easy way that you can commit to the accord is by ignoring a lot of the global opportunities and just focusing on a narrow origination channel. And that, albeit you were not going to be aware of the improved value that you could receive, I think the starting ethos of just trying to be aware of as many opportunities as possible does make that a challenge. And there's kind of an ambiguity of accountability between master trust and government that just needs to be worked through, I would argue.
Yeah, perfect. Coming to the last couple of questions. So it's time to gaze into our crystal balls a little bit and look ahead. No pressure. What's one investment trend or technology you think is going to play a role in reshaping DC in the next 5 years?
Reshaping DC or reshaping the
I've written DC pensions, but I mean, interpret as you will.
I mean, one investment I've made personally, without wanting to do any kind of financial promotion, is that I'm kind of aware of a microchip 3D printer. They actually just put one of their 3D printers on the International Space Station, for example.
Wow.
And if you think about the fact that 3D printer is actually, printing the microchip on an atomic scale. So what that means is it's using, I forget what the exact percentage is, but it's sort of 5% of the rare metals and all those types of things that you would otherwise be using. So you kind of really tapping into the scarcity of those kind of resources. And as things like oil and resources increasingly become scarce and the circular economy starts to come into play a little bit more, I think a lot of those technologies that are thinking forward about how we become more efficient with the resources that we have, I think are going to be really powerful.
Nice.
It's hard to have any conversation now without talking about AI.
Yeah.
Is that coming up in your investment committee? Obviously, it's be a topic that the investment teams themselves are talking about a lot. How are you thinking about that from a DC pension perspective?
Yeah, it's a very tricky one. I mean, the thing I would say is that the valuation piece is evolving very rapidly, right? Yeah. So it's very difficult to kind of call it. But that being said, there was a great. This is about 6 months ago or so. There was a nice picture of, ask ChatGPT, Google Bard, and DeepSeek what happened at the Tiananmen Square massacre. And they come up with very different answers. Really? And for DeepSeek, I'm afraid this is not part of my remit. Point being there that it's very easy to influence AI, in some ways. And increasingly, I think, we'll have to be very careful about the fact that AI is powered by data. And the more data you have, the more powerful it becomes, which is a very monopolistic tendency. So how we ensure long-term competition across the AI market is a really interesting one. And, there is an element of, well, can I trust it or not? Which does become about value, like when I say value, I mean values, like, moral values alignment across the various different regions, which starts to drive a different type of informational access, which is just quite interesting to think through. So, so I think in many ways that monopolistic tendency is likely to mean that a lot of the Western world will potentially prefer some of these very large players that, as they become, that value accelerates through the data dynamic. But it's one of those things that we kind of need to watch the policy on very closely, I would argue. But
in your view, what's one of the most underrated asset classes in DC?
Or investment themes.
You
can pick a theme.
Oh, testing me.
You don't have to.
Could be a common asset class that people just don't.
I do
hold value for.
I mean, we've started introducing gold, and I think that's pretty underutilized in many ways on approach to retirement.
How do you access the gold?
Through a physical ETC.
Right.
It does offer a lot of protective values, and I think increasingly as central banks start to allocate more and more to gold, and they've been slightly burnt by things like regulatory influence on cryptocurrencies, particularly, say, in the US, where admittedly the adoption is increasing.
Yeah.
I think the jury's out in how well that will be adopted by the more cautious institutional investors, like pension investors, for example. But I think gold still has a very strong ethos and uncorrelated protection dynamics, particularly to things like war and geopolitical risk that certainly feel like they're on the way up. And to be honest, we haven't actually also talked about things like defense and some of the increased investment that's happening there. And albeit valuations have kind of already run to a degree, we just need to be more mindful about the technologies in which could be used for those dynamics, how we consider them in a sustainable investing context, and make sure that we're kind of thinking about the social dynamics of war as well. And I'm not sure there's a kind of a unanimous view across the industry in terms of should you invest in defense, because it comes with a whole host of other peripheral things. But it does make sense that if you are avoiding war through defense, that is a huge benefit to a lot of people.
Yeah.
Now, how you achieve that is definitely up for argument. But a lot of things. But things like gold are very good at mitigating these in the interim if there are kind of these risks on the horizon as well. Yeah.
James, what haven't we asked you? Anything you were keen to cover that we haven't talked about?
No. I mean, excellent grilling. Well done, both.
Thank you very much for coming on the podcast. It's been lovely to have you.
Pleasure. Thanks, Jim. Pleasure. Thank you for listening to Changing World, New Opportunities, the DCIF's podcast.
Visit us online at dcif.co.uk, where you can read all our research, follow us on LinkedIn, and subscribe to the show.